Welcome back. My name is Jonah Beecroft. In this tutorial, we shall be taking accounting equation. Welcome back. In this section, you will learn accounting equation. You will learn all the components of accounting equation: assets, liability, and equity. You will also learn example of the components of accounting equation. Without wasting time, let's get our writing materials. Let's dive in. What is an accounting equation? Accounting equation is the foundation of the double entry bookkeeping. It shows the relationship between a business assets liability and equity. The foundation of the double entry bookkeeping, it shows the relationship between a business assets the business liability and equity. Accounting equation is represented as assets is equals to capital. Asset is equals to what? Capital. Or asset is equals to liability plus equity, where A is equals to what? Assets. L is equals to what? Liabilities. C is equals to capital, and E is equals to what? Equity. A is equals to L plus E, and L is equals to A minus E, and E is equals to A minus L are various ways of expressing the accounting equation. That means you may be asked to find assets, you may be asked to find liability, and you may be asked to owner's equity. Assets. Assets are split into 4 categories. Assets are split into 4 categories. Non-current assets, current assets, intangible assets, and wasting assets. We will take them one after the other. Non-current assets. The non-current assets are assets which are not expected to be used up are not expected to be converted into cash or used up within 1 year or one operating cycle, whichever that is what's longer. They are not expected to be converted into cash or used up within 1 year or within one operating cycle, whichever is what's longer. That is what non-current asset. Then current asset is the opposite. Non-current asset, they are assets which are expected to be converted, into cash. Or used up, converted into cash or used up within 1 year. They are to be used up within 1 year or within one operating cycle, whichever that comes first, whichever that is what comes last, whichever that is what longer. Intangible assets. They are non-physical assets that provide values to a business, often through exclusive rights or competition. Competitive advantage. Then wasting assets. Wasting assets are assets with limited useful life, deplete or exhausted over time, and lose value as they are used or extracted. Now we are going to take example of the assets, the classification: non-current assets, current assets, intangible assets, wasting assets. We are going to enumerate their example each. Non-current asset example is plants. You have machinery, you have land, that is a land and building, you have furniture, as they call it, furniture and fittings, and vehicle, etc. Those are examples of the non-current assets. Now, example of the current assets, we have cash. At times you say cash in hand and cash at bank. You have receivable. This one is formally called debtors. You have prepayments. We have inventories, as they call it, stock. Then, under intangible assets, we have goodwill. Goodwill. We have patents. Patents. At times we call it patent rights. Then trademark. We also have copyrights as example of intangible assets. Then finally, brand name. Then under the wasting assets, we have oil and gas reserve or oil and gas deposits or oil and gas reserve. Then we have mineral deposits. Mineral deposits. Then we have timberland. Timberland. There is mining rights and etc. So these are the examples of assets: the non-current asset, current asset, intangible asset, and the wasting what asset. These are the example. Now we want to add another to current asset. It looks as if it is very few. We have short-term investments and we have cash equivalent. Now we are going to talk of the liabilities. This next one of the components of the accounting equation. What are liabilities? Liabilities are short-term and long-term obligations of a business to its creditors. It may be to its creditors, to outsiders, or to third parties that the business have dealings with. Now, non-current liabilities. They are obligations that are not expected to be settled within 1 year or within one operating cycle of the company, whichever that is what longer. Then current liability are obligation that are expected to be settled within 1 year or within the company's normal operating cycle. Now, examples. I'm going to take example of liability. Example of non-current liability. An example of what? Current liability. The first example is example of non-current liability. The first one there is debenture, mortgage loan, long-term bank loan, long-term bank loan, and deferred taxation, deferred tax liability, deferred tax liability. We have also potential obligations, contingencies. Then we have capital lease obligation. Then deferred deferred compensations. These are examples of the non-current liability. Now we are going to also look at the example of current liability. Examples of current liabilities. Current liabilities are we'll talk about payables. Payables are formerly called creditors. Now we talk about the accrued expenses, the accrued expenses, and we talk about the bank overdraft, short-term bank loan. We talk about corporate tax payable, corporate tax payable. Then we talk about dividend payable, dividend payable. These are examples of current liabilities. Unremitted what? Pension. Unremitted pension, then unremitted payee, that is pay as you earn. These are examples of non-current liability and current what? Liability. Now we are going to take a look at what capital is. Capital is all the financial resources used to fund a business or fund a project or fund a company or a business operation and growth. All financial resources used to fund a business operation and also fund what? The growth is referred to as what? Capital. All financial resources, all of them that are used to fund the business operation and growth is called what? Capital. Then equity capital and debt capital are the major components of capital. The major component of capital are equity capital and what? Debt what? Capital. What are debt capital? Debt capital comprises loan and bonds other loan and bonds. Loans are private agreement between borrowers and lender with variable rate of interest. Example of loan are personal loan, mortgage loan, and business loans. And these are obtained in the banks or other financial institutions. Now, bonds. Bonds are public debt securities. They are now bonds. Now, bonds. Bonds are public debt securities. They are public debt securities. With fixed interest, with fixed rate of interest. With fixed rate of interest. Traded in financial markets. They are traded in financial markets. Bonds are public debt security with fixed rate of interest traded in financial markets. Yes. What are the examples of bonds? Bonds are public security with fixed rate of interest traded in the financial markets. Let us take a look at the examples of what? Bonds. Example of bonds. We have corporate bonds. We have the government bonds, and we have the municipal bonds. Corporate bonds, government bonds, and municipal bonds. Equity. Equity represents the owner's residual interest in the assets of a business or the asset of a company after deducting all the liabilities. Initial investments, that is ordinary shares. At times, ordinary shares are called common stock, and preference shares, which at times is called preference stock. Then we have retained earning or retained profits and other comprehensive income and other comprehensive income. That is to say, the components of equity are ordinary shares or common stock, preference shares or preference stock, are retained earning or retained profits, and other comprehensive income. you will discover that all the components them take home. Assets is equals to what? Capital. That is, the asset of a business is claimable by the capital. Asset is equals to what? Capital. That is the first equation. That's another way of expressing the accounting equation. Another way of expressing capital is the same thing as liability plus equity. Capital comprises of liability, which are claims from us, from third party, and equity, which are claims of the owner of the business. Then the third one is asset is equals to liability plus equity. This is the major one we call the accounting equation. Then the fourth one is equity is equals to asset minus liability. Equity is equal to asset minus liability. And the fifth one is liability is equal to asset minus equity. Now, this is a summary of what we have just done. Now, you may be asked to calculate the assets. You may be asked to calculate the capital. If you are asked to calculate the asset, number one, asset is equal to what? Capital. If you are asked to calculate the capital, capital is equal to what? Equity, and so on. You will also be asked to calculate the working capital. The working capital is equal to current assets minus current liability. Working capital, current assets minus current liability. You may also be asked to calculate the net worth. The net worth, otherwise known as the net assets. The net worth is seen as net asset, is total asset minus total liability. Total asset minus total liability, that's what the net worth. You may also be asked to calculate the change in equity. That is where there is an increase or decrease in debt equity. You will also be asked, or you may also be asked to calculate the retained profit or retained earning. It is important to note that capital is not the same thing as equity. Capital is the universal set, while equity is a subset. Equity is an integral part of what? Capital. As you can discover in the above explanation, capital is not the same thing as equity. Equity is the subset of what? Capital, while capital is the universal asset. All the components of equity are capital and component of capital, but not all the components of equity. Now, we want to take a practice. We want to take practice. We take only this practice and call it a day. Use the information below to answer the following question. You have $sign. Cash at hand is equals to what? 30,000. At $30, cash in bank is $26. Premises is $80,000. Then short-term loan is 20,000. Calculate short-term loan. Current assets. 2. Non-current assets. 3. Current liability. Now, the mix of assets and liability. They ask you to find the current asset. Current assets are cash at hand and cash in bank. Then the non-current asset there is premises, while current liability is what? Short-term loan. Now the current asset is equal to cash at bank plus cash at hand, which is $30 plus $20 plus $26, which is equal to what? $56. Then the non-current asset there is only one, which is what? Premises, and is what? $80. Then the current liability there is also one, which is what? Short-term loan. On this note, we come to the end of this tutorial. This is accounting equation 1. In our next tutorial, we shall take so